Hey everyone, welcome back to Corporate Decoder, the place where we'll unpack today's SEC filing and see if there is a hidden story behind all those numbers, or maybe just a whole lot of legalese. Let's dive into the PIMCO Flexible Emerging Markets Income Fund's latest N-2 filing and see what juicy details we can uncover, especially concerning their bottom line and what they're promising investors. First up, let's talk about the money going out. The fund pays PIMCO, the investment manager, a fee of 1.30% of the fund's total managed assets. Now, this is essentially an all-in fee for advisory, supervisory, administrative, and other services. So, while it sounds like one number, it covers a bunch of different jobs. Looking at the total annual fund operating expenses, things get a bit more interesting across the different share classes. For the institutional class, total operating expenses after any fee waivers are about 2.29%. But for the other classes like class -1 and a -2, they're higher, around 2.79%, and for a -4, it creeps up to 3.04%, so buying the fancier institutional shares saves you money in the long run on fees compared to the retail classes. Interestingly, there is a significant chunk for interest payments on borrowed funds, about 0.72% across all share classes. This tells us the fund is using leverage mainly through reverse repurchase agreements to try and boost returns. While leverage can magnify gains, it also magnifies losses. And that interest expense is a real cost borne by the shareholders. Let's look at what this potentially means for you. On a $1,000 investment after 10 years, the example shows you could be paying anywhere from $264 for institutional class shares to $357 for class and -4 shares, assuming a hypothetical 5% annual return. That is a noticeable difference, and it highlights how those extra fees on the retail share classes add up over time. Now, onto the actual investments. The fund's main goal is to provide attractive risk-adjusted returns and current income. They do this by investing in instruments tied to emerging market countries. They're using a flexible strategy to move between different public and private credit sectors, including corporate debt, mortgage, related instruments, government debt, and other income-producing securities. They can invest in both investment-grade and below investment-grade debt, commonly known as high-yield or junk bonds, even from stressed or defaulted issuers. But here is where things get risky. They explicitly call out emerging markets risk. Investing in these countries is tougher because of things like less stable political situations, less developed regulatory systems, a higher chance of currency devaluation, and even the possibility of governments taking over assets. This isn't just a small risk, it is described as particularly high and heightened to a degree. They also warn about foreign non-us investment risk, noting that these markets can change value more rapidly and extremely than us markets. There are differences in financial reporting, legal standards, and even trading hours can limit their ability to buy and sell quickly. Plus, government actions like capital controls or trade restrictions can really impact investments. Then there is the general market risk. This is the everyday fluctuation in security prices due to broad market conditions, industry trends, or even investor sentiment. Geopolitical events like wars, terrorism, or pandemics can all shake up markets. Basically, the value of what they invest in can drop unpredictably. Remember that interest expense we saw earlier. This relates to their leverage risk. The filing mentions they primarily use reverse repurchase agreements and may use credit default swaps, dollar rolls, and borrowings. Leveraged investing can boost returns but also amplifies losses. They're upfront that this is a speculative technique with special risks and costs, and the net asset value and yield can become much more volatile. As an interval fund, they make quarterly offers to repurchase shares, usually 5% of what they have outstanding, but they warn that investors should consider their shares illiquid. There is no guarantee you can sell when you want or in the amount you desire. If a repurchase offer is oversubscribed, you might have to wait until the next one, and your shares could lose value in the meantime. There is also a section called Conflicts of Interest. This is where PIMCO, the investment manager, admits that their business involves a broad spectrum of financial services, and sometimes their interests or the interests of their other clients might clash with the fund's interests. This can affect investment decisions, how trades are allocated, and even how they choose service providers. They even mention that their compensation structure tied to total managed assets could incentivize them to use leverage, which might not always be in the best interest of shareholders. Finally, let's look at how these various costs add up. Beyond the management fees, there are distribution fees, interest on borrowed funds, and other expenses. For example, the class of -4 shares have a total annual operating expense after waivers of 3.04%. This means that out of every dollar invested, over 3 cents go to expenses each year before any investment gains or losses. Over the long term, these costs can really eat into your returns. Overall, this filing paints a picture of an investment fund operating in complex and high-risk markets, using leverage to try and boost returns while acknowledging significant risks and potential conflicts of interest. The fee structure, especially for the retail share classes, also means a substantial portion of your investment goes towards expenses. What is your take on this filing? Does the potential for higher returns in emerging markets, combined with leverage, seem worth the elevated risks and costs? Let me know your thoughts in the comments below. If you found this deep dive helpful, give this video a thumbs up and subscribe to Corporate Decoder for more breakdowns like this. And hey, if you want to chat more about these filings and other corporate finance topics, join our Discord community linked in the description. Thanks for watching, and I'll see you in the next one. Hey everyone, welcome back to Corporate Decoder, the place where we'll unpack today's SEC IC and see if there is a hidden story behind all those numbers, or maybe just a whole lot of legalese. So, PIMCO Flexible Emerging Markets Income Fund has dropped its latest N-2 filing, and it is packed with the usual mix of investment strategies, risk disclosures, and of course the nitty-gritty on fees. Let's decode what it all means. First, the fund pays its investment manager, PIMCO, a unified management fee. This fee is 1.30% of the fund's average daily total managed assets. This covers advisory, supervisory, administrative, and other services, essentially an all-in package. Now, when we look at the total annual fund operating expenses after fee waivers, there is a clear difference between the share classes. The institutional class is the leanest at about 2.29%, but the retail classes are more expensive, with class a -1 and a -2 at 2.79%, and class a -3 and a -4 hitting 3.04%. So, even before we talk about investment performance, the fees are significantly higher for the retail investor. A prominent line item is interest payments on borrowed funds, accounting for about 0.72% of expenses. This signals that the fund is using leverage, primarily through reverse repurchase agreements, to juice potential returns. While leverage can amplify gains, it also amplifies losses. And that interest cost is a direct hit to shareholder value. Let's put this into perspective with the example provided. On a $1,000 investment, assuming a hypothetical 5% annual return, you are looking at paying around $264 in expenses over 10 years for institutional class shares. But for class a -4 shares, that figure jumps to about $357, that difference driven by those higher annual operating expenses. Really adds up over a decade. The fund's core strategy is to offer attractive risk-adjusted returns and current income by investing in emerging market countries. They're flexible, moving across public and private credit sectors, including corporate debt like bonds and loans, mortgage-related assets, and government debt. Notably, they can invest without limits in below investment grade debt, often called high yield or junk bonds, and they're not shy about including stressed or even defaulted issuers in their mix. This is where the red flags start flying. The filing very clearly outlines emerging markets risk, stating it is particularly high and heightened to a degree. This means dealing with political instability, unpredictable government policies, currency fluctuations, potential restrictions on moving money out of countries, and even the risk of nationalization or confiscatory taxation. The markets are also described as less regulated and less liquid, which can lead to wild price swings. Beyond emerging markets, there is the broader foreign non-US investment risk. These markets can be more volatile and less liquid than US markets. Disclosure and regulatory standards can be different, and trading hours alone can create challenges in buying and selling efficiently. Government actions like capital controls or trade restrictions add another layer of uncertainty. Then we have the everyday market risk. This covers price fluctuations due to general economic conditions, industry trends, or even just investor sentiment. Geopolitical events, from wars to pandemics, can create market disruptions that hit investments hard regardless of their individual merit. That earlier mention of interest payments takes us to leverage risk. The fund uses tools like reverse repurchase agreements, credit default swaps, and dollar rolls to borrow money and invest more. While this can amplify gains, it equally magnifies losses. They acknowledge this is a speculative technique with special risks, leading to more volatile net asset values and yields for shareholders. Because this is an interval fund, they make quarterly offers to buy back shares, but crucially, they warn investors that shares should be considered illiquid. You may not be able to sell when you want or in the quantity you want. If more people want to sell than the fund can buy back, your request might be prorated, meaning you could have to wait for the next offer, all while the value of your investment could be changing. The filing candidly addresses conflicts of interest. PIMCO, as the manager, admits its broad financial dealings can sometimes create situations where its interests or those of its other clients don't perfectly align with this fund's shareholders. This can impact investment decisions and even lead to incentives for using leverage, which, as we've seen, comes with its own set of risks. Let's circle back to costs. The fee table shows that even after waivers, the total annual operating expenses vary significantly by share class, ranging from around 2.29% for institutional shares to over 3% for the A-3 and a -4 classes. When you add in the interest expense from borrowing, those costs become even more significant. Looking at the financials, my main takeaway is this fund operates in a very high-risk environment. They are actively trying to generate income and returns by investing in emerging markets and using leverage, which inherently comes with significant volatility and potential for loss. They are very upfront about the risks involved, which is good. But investors need to be acutely aware of just how much uncertainty they are signing up for. The higher fees on the retail share classes are also a definite point to consider for long-term investors. What is your take on this filing? Does the potential for higher returns in emerging markets combined with leverage seem worth the elevated risks and costs? Let me know your thoughts in the comments below. If you found this deep dive helpful, give this video a thumbs up and subscribe to Corporate Decoder for more breakdowns like this. And hey, if you want to chat more about these filings and other corporate finance topics, join our Discord community linked in the description. Thanks for watching. See you next time.